Banks take our money, invest it, earn 5%, and pay us 1% when the things they invest in to earn the 5% we could do ourselves. Welcome, my name is McCluskey. This past year, we got 1.3 million out of banks earning far higher rates of return for 24 clients. Today, we're going to go over much deeper how banks work, what they're investing in, and how you can do it too. So banks are not generally coming into the banking business with billions of dollars. They're taking our money and investing it into these things here. So loans, for example, these are not going to be as accessible to us, and generally a big portion of these loans are frankly just going to be them taking advantage of people, well, who probably didn't know much better than to get them, and now they're paying very high interest rates on this money. The second, which is directly accessible to us, is government bonds. That's treasury bills, treasury bonds, treasury notes. You can go directly to treasurydirect.gov and buy these yourself. However, people put money in banks and they go and buy them and then credit us less interest. Now, I will say right away, these are ones you generally would hold until maturity. And if people are just keeping money in a bank because they want it to be liquid, well, it's understandable why they wouldn't go directly to the government to put money here, because why? Well, they want it to be liquid and they're willing to take a lower percentage for the banks to be the ones that have their money locked up and promise us that our money is liquid if we keep it in the bank. We'll go back into that in a second. The third is real estate, which of course, through any realtor, anyone could go and get real estate on their own. Same objection here with real estate though. Well, if most people are wanting to keep their money very liquid, they're likely not going to want to have it locked up in real estate. Therefore, they're going to just put it in a bank, let them buy the real estate and lack the liquidity so they can promise us that we have it. The last place, and this is where, because you imagine, well, banks probably need some liquidity too as well, right? Well, where are they keeping their liquid assets? Are they keeping them in other banks? Because they could do that. No, they're not. They're keeping them in cash value life insurance. I have here Bank of America as of January 2020, this was from AI, had $24 billion in cash value life insurance. Why do they do this? Why do they keep their serious liquid cash, their assets here? Why do the CEOs of McDonald's, Walt Disney, J.C. Penney keep their money in cash value life insurance? That's because it's liquid. They follow the same thing the big banks do. They could keep their money in a bank and just let it earn interest, withdraw, use it whenever they need to. However, they could also just look what the banks are doing and do it themselves, cut out the middleman, and earn that rate of return for themselves. This way, if the main goal is keeping the money liquid, well, you don't want to go and buy the government bonds necessarily. You don't necessarily want to buy real estate because you don't solve the problem of keeping your money liquid. But with the cash value life insurance, you do. You do the same thing the banks do themselves. Get rid of them and access when you want. Now, first, there's a much simpler solution, which is that a lot of people, when the banks are earning 5%, are getting credited 1% or even less to that in their savings or checking accounts. The very simple solution is many banks have what is called a high yield savings account, where they are earning 5 and they're going to go ahead and credit you 4. They just credit you much more money. Why do some banks not do this? The banks say, well, hey, if you guys are just holding the money there and we're crediting you 1% and you're not complaining, well, why are we going to adjust our rates and get competitive and up it to 4? So that's why some of them still don't do a high yield savings, but there are plenty of banks out there that credit 3, 4, 5%, depending on the interest rate and the environment. So a very simple fix, if you have one of those low yield savings accounts, is just switch to a higher yield savings account. This is exactly what I do for the money that I need immediately. Now let's get into the better liquid solution, that is the cash value life insurance. Before we dive too deep into that, what we're going to do here first is compare banks versus insurance companies. Because banks, as we see here on the left, do that chart of having our money, investing it, earning 5%, and let's say paying 4% if it was the high yield savings. Well, insurance companies, you imagine if they're keeping money, what are they doing? The same thing. They take insurance premiums, they invest that, they earn a rate of return, and they are able to credit cash value on insurance policies interest. The difference is some of where they invest the money is different. Why? Because, well, number one, insurance companies aren't putting their money in other insurance companies and having cash value life insurance. So banks have cash value life insurance, insurance companies don't. Why? Well, because they are the insurance companies. Also, insurance companies aren't in as big of a need of liquidity because required by the government, they simply couldn't be as risky as banks if they wanted to be. That's why you might see loan to value ratios as high as 80 or higher percent on a bank, with insurance companies being much more like 50%. That's why if you look at the Great Depression, if you look at 2008, you have thousands, if not hundreds for 2008, of banks going under and little to no insurance companies. And the ones that did, like AIG, for example, does get picked up. Policyholders are still paid out. The next thing here with the insurance company is you're going to be able to access, this is what banks understand, that money tax-free. So that's the difference in safety between the organizations, how they invest their money, and then the tax advantages of the insurance companies when you're using the cash value side of things, as opposed to the banks where you're going to be taxed as earned. Even if you're just getting 1%, you're still getting taxed on that 1% on your tax return each year. Now let's look at a very simple cash value life insurance setup. If you say, okay, this makes sense, but how do I actually do this? Well, here's how it works, because some people might think, well, I don't really need insurance, so why am I using this? The idea is you put money in, that money grows, you're not paying taxes as it grows. You are then able to access that money tax-free. Why is that? That's because this is not considered by the IRS to be an investment. It is considered life insurance. Life insurance, according to the tax code, according to tax code 7702, 72E, and 101A, money is growing tax deferred, can be accessed tax-free, and transfers income tax-free when someone passes away. So since this is the case, what the big banks are doing, what those major entrepreneurs are doing, is they are saying, what if I got an insurance policy and I wanted the most amount of money that I pay to this insurance company that is legally required or allowed by the IRS to go towards the cash value, and the least amount possible allowed by the IRS to go towards the death benefit. If that's the case, you have that very small cost of insurance and all the rest goes towards the cash value, then that familiar process we've already gone over repeats. So we have the cash value. What happens with the cash value? It gets credited interest, just like we put money in a bank. They invest it and they credit us interest. That's where we are here. And then each year, that's just going to repeat. The same system the banks and the entrepreneurs are using. They put the money in, least amount towards the cost of insurance, most towards the cash value. They get credited interest from the insurance company that's investing money somewhere else. We are able to grow this money tax deferred, access it tax-free, and it's going to compound year over year, not paying any taxes. When we pass away, what happens? The money transfers income tax-free. Some final remarks here. First, this is a long-term solution. It's not something where it's like switching from one bank account to another, and 3 years in you say, I'm gonna go ahead and switch to another bank. With this, if you are going to use this strategy, it's one you definitely need to commit to and say, this is going to be my own little bank here that I'm going to keep for the next 20, 30, even longer years. If you have that approach in mind, that's where this can really work. If you're trying to cancel after 5, 10 years or switch to another insurance company or move it out from there and into a bank, you're definitely not going to reap the benefits. That's because these are front-loaded with fees, just like a mortgage where you're paying all the interest up front. Same deal with these cash value insurance policies. Over the long haul, retroactive back to day one, the internal rate of returns are still very competitive. Of course, that's why banks and big entrepreneurs still do this. If they weren't, then why would they? Next is that proper structure to these policies is key. It's not just using an indexed universal life insurance policy or a whole life policy to do this and setting it up, and once you have it, it's good. Not all of these policies are the exact same. You have the product, but it's not necessarily about the product. It's about the way the product is set up and the strategy you use with that setup. If it's not set up properly from the very beginning, this is where you could get into trouble, so you do need to make sure that you're with an agent that knows their stuff. And then the last thing here is continue to educate yourself, especially if this is your first time learning about a product like this. I make videos on this 3 times a week. I also do a live stream once a week. Feel free to subscribe, and I will see you in one of those videos. Bye-bye.